Hi, my name is Shammi Prabhakar and you are watching Charter Times. Today we are going to discuss IFRS 1, which is first time adoption of IFRS, International Financial Reporting Standards. We are going to cover the purpose of this standard. Apart from that, we'll see the implications, the applicability of the standards and all other standards which are guided through this particular IFRS 1. A major part of this IFRS includes the exceptions where you have a choice to apply this IFRS or just have alternative given by the standard itself, and the disclosure requirements. So it can be primarily divided in these four parts. So the ultimate purpose of this IFRS 1 is to guide you through presenting your first IFRS financial statement using all effective IFRSs in a proper way on the reporting date, and present the comparatives as well in a way that IFRS was always there in previous period as well. So it takes you to a roller coaster ride wherein you are replacing your existing GAAP, the old GAAP, whatever it was, US GAAP or any particular country's GAAP, and you are bringing in IFRS for the very first time. It tells you how to present your very first financial statement, what should be included, what should be excluded, and it only talks about certain exceptions which are exclusively available for the first time, or certain flexibility it gives you in terms of difficulties when you have for certain measurements or certain particular provisions which are in normal course you have to apply, but this standard saves you from the difficulty of applying many standards which are almost impractical and very expensive in the first year. So that's the ultimate purpose of this particular standards. It's a helping hand for implementation, you can say, in a shortcut, and apart from that it helps you to prepare your comparatives as well in a way that your comparatives as well, assuming that IFRS was always there for you. So don't get confused here, we'll look into it in details how to do this. One of the very interesting concept, one of the driving concept of this particular standard is the transition date. So usually when we talk about a transition date in a normal scenario, you find it out that okay, the date when you are moving from one thing to the other thing, but here it's a bit different. If you have to implement, 1st January 2020 is your date of implementation of IFRS, and you are going to prepare your first annual financials only on 31st December 2020. So the transition date in this case will not be the 1st January 2020, rather it will be 1st of January 2019, because you have to present minimum 1 year comparative for most of the financial statement components. For one of the component you have to even present for 2 years comparatives, but minimum is 1 for most of it. So the transition date is always taken a year back when you are going to implement it. So then another twist to the story here is when you are preparing opening financial statement, you are preparing the opening statement of financial position, for the company in very first place on the transition date. You have to use the same IFRSs which are applicable not on that date, rather on the date of your first reporting. So in the given example, if the first reporting date is 31st of December 2020, the applicability of standards will be identified on that particular date of 31st December 2020, and those standards will be used for preparing the opening statement of financial position on 1st of January 2019. So you have to get into a time machine 2 years later, find out what is in there at that point of time, get back to 1st January 2019, and then prepare your financial statement. This particular step, preparing the opening financial statement, needs a lot of recognition, measurement, and reclassification of assets as well as liabilities. due to transition from the previous GAAP to IFRS. There could be many assets which were recognized in your previous GAAP, which doesn't need to be there anymore in IFRS. There could be many assets which were not recognized, but now you need to recognize them in your books as per IFRS. Similarly, there would be a lot of changes from the measurement principle. There could be many assets on the cost measurement basis which you have to make it on fair value, or vice versa. There could be many assets which could be classified from one category to the other category as a transition provision requirement. So just to reconcile all these differences, just to make it more useful for the users of the financial statement, you also need to prepare a mandatory reconciliation between the previous GAAP and IFRS, which has to be attached with your first financial statement. So we'll look into it, the disclosure requirement, a bit later. First of all, we have to see the applicability. So IFRS 1 is generally applied only once. There are certain hypothetical examples, we'll not get into it, but it's only applicable for the first year when you are going to implement IFRS for your entity. It doesn't mandate any preparation of interim financial statement, but in case you are preparing an interim financial statement, then it asks you to follow the same rules which you follow for preparing the annual financial statement. So there is no exceptions in the name of only interim financial statement if you just want to get some exceptions there. Now, one of the best principle you have to always remember is whatever reclassifications or measurement or any other changes are arising from the GAAP changes, from the transition. So any kind of transition differences arising from the asset or from the liability, they will all be recorded in retained earnings. So the opening balance adjustment, when you are preparing the opening statement of financial positions, all the differences out there from the transition effect will get into retained earnings or other equity components. So for example, other equity, you should not get confused. So most of the time it's retained earning, but for example, if there is a revaluation surplus account for the PPE, for property, plant and equipment, as per IAS 16, you can take the differences, you can take the transition difference to the revaluation surplus account instead of taking it to the retained earning account. There are a lot of exceptions in this particular standard, and it's only there to help you out with the transition. So you have to know what are your benefits, what are the flexibilities the standard is giving to you. If you miss out any of these exceptions, probably you will be losing a lot of time and money on if you don't know what are your rights. So there are a couple of mandatory exceptions which everyone has to follow, irrespective, there is no choice there. So they're pretty simple. So if there is any derecognition of financial instrument, it's covered in mandatory exceptions. Hedge accounting, estimate changes are not required to be done for transition difference unless there is an evidence, objective evidence for an error. Consolidation and non-controlling interest are part of mandatory exceptions. Government loans at subsidized rate of interest, usually to consider it as a grant or financial asset. These are also part of the mandatory exceptions, which are always useful if it's applicable for your entity. There are a lot of optional exemptions wherein standard asks you to follow an alternate method. So you have one method specified by other IFRSs, guided by other IFRSs which are applicable to you, but you have an alternate way given by IFRS 1 which will help you to save a lot of cost and efforts at the time of transition. One of the first one, if I talk about if there is a business combination, if there is a business combination which is acquired particularly before the transition date, you have certain exemptions which are very useful in terms of accounting that business combination in IFRS. If there is a deemed cost, so deemed cost, if I just try to explain it, there are certain ways to calculate your cost in different standards for different kind of assets and liabilities. For example, IS 16 deals with the property, plant of equipment, and it asks you to value your asset in a certain way. Similarly, there is a standard for investment property. There is a separate standard for intangible assets. There are rate regulated entities. All these particular standards gets an exemption here, so you get an alternate way. So you don't need to follow certainly the way standard is telling you, but you have certain other ways also given by this particular standard only for the first year. These benefits will not be carried forward after the transition period, after the IFRS is implemented. So it's only available for the year 1. Similarly, in terms of employee benefits, you have a couple of exemptions available specifically for actuarial gains or loss under corridor method. Although this method is discontinued now, it's not relevant anymore, but there could be entities which have actuarial gain or losses carried forward from a corridor method followed in the past. For that particular amount, you get an exemption here. If there is a translation difference by converting your currency from one to another for different kind of reportings, that gets certain very useful exemptions, and it's applicable for most of the entities, specifically who are preparing their books in different currencies. Then compound financial instrument is one of the most technical provisions under IFRS, which are dealt in a specific way. So wherein you have to separate your equity and debt portion from a compound financial instrument. For example, if there is a convertible debenture, compulsorily convertible debentures, it will have equity component as well, which has to be separated from the debt. So this separation exercise gets an exemption, it gets an alternate, specifically if that debt amount is already paid off, if that debt is not payable as on date of transition. So there are certain exemptions, but there is always attached condition and alternate suggested way. So you cannot just find it exempted and you can do it in your own way. But what you find here is you get options to choose which is more convenient for you if you are qualifying for the conditions. The next one and the best one you can talk about is goodwill. In terms of specifically if intangible assets are there and their transition effect, which is created by recognition or derecognition of any self-generated assets or any kind of intangible assets, it gets a liberty here to get adjusted with the goodwill instead of transferring it to the retained earnings. In terms of asset and liabilities of subsidiaries, JVs, associates, it allows the difference in transition date. So if your subsidiary or if your joint venture or associate has a different reporting date, or they are already on IFRS, or you are already on IFRS and they are now getting transitioned, there could be multiple scenarios. They are all given certain exemptions here in this particular standard depending on case to case. So it is specifically dealing with the dates. It gets some exemption, which is very important. You don't need to restate everything without looking into these exemptions and options available for you. Next one, if I talk about share-based payment, there are exemptions available for share-based payments, specifically for the equity options. If the conditions are, if the option is already vested, the conditions is attached to it, or in cash settlement also, if there is a cash option which is settled already before the transition date, it gets certain exemptions from the share-based payment standards, IFRS 2. In insurance contracts, similarly, it gets a lot of disclosure related exemptions. For leases, it gets exemption from the lease standard requirements, specifically for measurement and accounting. The fair valuation of financial instrument, specifically initial recognition, gets exemption here. The service concession arrangement, I'll tell you what is service concession arrangement before I get into the exception. So to help you to understand, if you find it next time in your books. So a service concession arrangement is something wherein a private company participate in a public sector service, for a contract, through an arrangement. Those kind of contracts get certain exemptions. The borrowing cost, specifically which were before the transition date, the investments specifically measured at cost or IS 39 as per the standard, but IFRS 1 allows you to take the deemed cost if there is any impracticability or difficulty, or benefits are far lesser than the cost for doing the valuation. So if you are qualifying all these conditions, it gives you a third way of measuring your investment, which is deemed cost again, which we have seen earlier. So similarly, the joint arrangements, for impairment testing, there are separate provisions given in this particular standard. So even if you don't have indicators on a certain date, you can still go for impairment testing. For customer asset transfer, so in this case also, for the customer asset transfer, you have to account it on a cost or a fair value, but here it gives you additional provision, additional way out, site restoration cost, which is to be considered as part of property, plant and equipment if you go by I-16. But this particular standard allows you, because earlier this provision was not there, it allows you to take it on historical cost if you are able to meet the conditions given in the standard. So there are too many exemptions listed and explained, elaborated very well in this particular standard, which are the backbone of this particular standard. You need to understand each of them. You have to identify which are applicable for your particular entity, and you must avail the benefits available under this before you just go with blind application of all applicable IFRSs for your entity. How to make these changes, how to implement IFRS in first go, the easiest and the most common approach, even a standard suggests, is you have to make changes in the accounting policies itself of the company to make it compliant with IFRS provisions. So you have to change your accounting policies, which were earlier designed keeping your existing GAAP in mind. You have to refer the differences with IFRS and make necessary changes in the policies, and if required you might need to bring in couple of new policies, or you have to trash couple of existing policies as well. The last part and very important part of this particular standard is the presentation. So the minimum documents which are specified by the standards, I'm going to tell you quickly. So you have to prepare the statement of financial position for 3 periods. So one for the current one and 2 comparatives specifically for the financial position, which is balance sheet. For rest of the documents which you prepare as part of financial statement, like your comprehensive income statement, your cash flow statement, your equity statement, you can prepare 2 sets, one for the current and one for comparative. So you don't necessarily need to prepare 2 comparatives for other statements. You have to prepare all the notes for all the financial position statement which you are preparing and all other statements you are preparing, including the cash flow, equity statement and everything, to explain all the details of these statements for the current period as well as the comparatives. Then you have to prepare a statement containing effect of transition from previous GAAP to IFRS, specifically the effect on the financial statement. So that is a separate statement which is prepared only for the first time adoption as per IFRS 1 requirement, and you have to mandatorily prepare this as part of your financial statement checklist only. Then you have to prepare a reconciliation of equity between previous GAAP and IFRS. That reconciliation has to be prepared on the transition date as well as the reporting date of latest financials prepared under previous GAAP, not on the reporting date of IFRS, rather the last reporting date under the previous GAAP. Then you have to prepare a reconciliation of total comprehensive income between previous GAAP and IFRS, as I said in beginning itself. for the same period. Now, reconciliation of total comprehensive income is prepared for the comparative period, as you know, in given example if we take. So you have to prepare the statement of the example which we discussed initially when you are implementing the IFRS for 1st of January and your first reporting date is falling on 31st of December 2020. In that case, the statement of financial positions will be prepared for 2020, 2019 and 2018. Statement of comprehensive income will be prepared for 2020 and 2019, but for 2019 you have to prepare the statement of comprehensive income as per the IFRS as well as the existing GAAP, the old GAAP, and you have to compare these two and prepare a reconciliation which we are talking about. Then you have to prepare a transition impact on cash flow which shall be presented. However, IFRS 1 doesn't specify a reconciliation period or any other details for this particular statement, but you have to prepare this. Impairment changes have to be presented separately, it's a mandatory requirement. So any recognition or reversal of impairment has to be disclosed specifically. Any errors of the previous GAAP, if you found out during the transition period, it has to be disclosed separately. And it has not to be merged with any policy changes or estimate changes. So, the user of the financial statement under IFRS needs to understand the impact of the errors identified in the previous GAAP as well. Then you have to disclose the exemptions which you are going to avail. The list of exemptions we have already gone through. So, whichever exemptions are applicable for you, which you are going to use for your entity, has to be disclosed in the notes to account very precisely. And if there is an interim financial statement also which you are preparing, then as I said, all the disclosures and all other requirements will remain similar to the annual financial statements. These are the mandatory disclosure requirement. So if you are able to understand what we talked about, I assume you know almost everything about IFRS 1. Specifically when you don't have to manage an implementation, but when you are actually getting into a live implementation phase for an entity, you have to get into details of each and every exception specifically. That is the first exercise you have to do to identify what is the options available for your particular entity before you get on the floor. So that's all about IFRS 1. Very soon I will be coming with other IFRSs as well. Thank you so much for your time. Subscribe to our channel. Take care.